Cash flow forecasting is the process of estimating and predicting the future inflows and outflows of cash within a business over a specific period, typically a month, quarter, or year. It helps businesses anticipate their future cash needs, identify potential cash shortages or surpluses, and make informed decisions to manage liquidity and optimize financial resources. Here's how to predict cash flows for financial planning. Gather historical data. Collect historical cash flow data from previous periods, such as cash receipts, cash disbursements, operating expenses, capital expenditures, loan repayments, and other cash transactions. Identify cash flow components. Break down cash flows into different components, including operating cash flow, investing cash flow, and financing cash flow. Operating cash flow includes cash generated from core business activities, such as sales revenue, accounts receivable collections, and payments to suppliers. Investing cash flow includes cash flows related to the purchase or sale of assets, such as property, equipment, and investments. Financing cash flow includes cash flows related to borrowing, debt repayment, equity financing, dividends, and stock repurchases. Analyze revenue and expense patterns. Analyze revenue and expense patterns to identify seasonal fluctuations, cyclical trends, and one-time events that may impact cash flows. Consider factors such as sales cycles, payment terms, inventory turnover, supplier payments, payroll schedules, and tax obligations. Forecast sales and revenue. Estimate future sales and revenue based on sales forecasts, customer orders, contracts, and historical sales data. Consider market demand, industry trends, competitive dynamics, economic conditions, and marketing initiatives when forecasting sales. Project operating expenses. Project operating expenses, including costs of goods sold, payroll expenses, rent, utilities, marketing expenses, and other operating costs. Use historical expense ratios, budgeted expenses, cost projections, and inflation rates to estimate future operating expenses. Estimate capital expenditures. Estimate capital expenditures, CapEx, for investments in property, plant, equipment, and other long-term assets. Consider planned projects, equipment upgrades, maintenance needs, and expansion initiatives when forecasting CapEx. Forecast financing activities. Forecast financing activities such as borrowing, loan repayments, interest payments, dividends, equity financing, and debt issuance. Consider existing debt obligations, credit facilities, interest rates, dividend policies, and capital structure when projecting financing cash flows. Build cash flow models. Use cash flow forecasting models, spreadsheets, or financial planning software to organize and analyze cash flow projections. Develop detailed cash flow statements that reconcile cash inflows and outflows to calculate net cash flow for each period. Review and adjust forecasts. Review cash flow forecasts regularly and update them based on actual performance, changing market conditions, and new information. Compare forecasted cash flows to actual cash flows to assess accuracy, identify variances, and refine future forecasts. By predicting cash flows for financial planning, businesses can improve liquidity management, anticipate funding needs, mitigate cash flow risks, and make informed decisions to support sustainable growth and financial stability.